In this section, we're going to explain the basics of budgeting and maybe also show you a couple of benefits of what good budgeting will hold for the organization or for yourself personally. It is a cliche, but it is still true. If we can start with that saying, if you fail to plan, you plan to fail. And budgeting is a very important part of planning. What is a budget? A budget is a way of deciding where your money is allocated. We don't have endless supply of funds or resources, so to budget you decide where you're going to allocate your funds or your resources the best way. It is a financial plan which assists you to plan your future savings and expenditure, so you are able to estimate how much you will be spending and how much you can be saving from the actual income that you make. A budget should always be future focused. It takes into account the projected cash flows of the business, plans for the business, structures, what costs are expected, saving plans, etc. This is a saying that you might need to consider. Budget is telling your money where to go instead of afterwards wondering where it went. There are three important elements of a budget. First of all is the goal. The budget needs to be based on where the organization wants to be. So does the organization want to grow? Does the organization want to just maintain where it is? Does it simply want to survive? These goals must be set for the short, the medium and the long term. Set all those goals, and then the budget is supposed to work around those in order to make it happen. Another element of a budget is control. The budget gives the entity control over where it is going. It helps the organization to control that it moves towards the goals that it has set. The entity needs to have control over the specific activities, control over expenditure, production plans, etc. The budget then says how you would control those in order to get to your ultimate plan objective. The third element is a budget has to be useful. The budget must first of all be directed at goals or priorities. As we said on the previous slide, if you are aiming to grow, then the budget should be directed at growth. The allocation of resources is then obviously based on the most important goal or priority. So if your priority is to increase stock, or your priority is to develop staff, then the budget should support that. And it's important that the budget thinks long term or be futuristic. Look at the end picture in mind, look at where you want to be, and then work your way back towards a budget. And then once you've got the budget is used to control all the activities or coordinate all the activities of all departments. If the sales department is budgeting to make 10% increase in turnover from last year, then it doesn't help if the production budget is 20% increase. Then we're going to end up with too much stock, or if we're not producing enough, or we're not marketing enough. So all the departments' activities and divisions' activities should be coordinated to ensure that they all work towards a common goal. You hear people talking about a balanced budget, a surplus budget, or a deficit budget. A balanced budget is a budget where the total income that we are planning is equal to the total expenditure. You sometimes find that companies plan for a surplus budget, so where the total income will be more than the total expenditure. That could mean that maybe they are planning for some capital investment or something like that, where they need to budget for more income than expenses, or otherwise a deficit budget. That also happens sometimes, especially in difficult times when you need to plan and you know that you're going to end up at a deficit. Benefit of that is obviously then you can plan for finance. You're not going to be surprised when your money eventually does run out, because you will know that you've expected it and you are ready for it. What are the considerations when you prepare a budget? You should at least look at these few things. This is a very simplistic way of looking at it, but this is the minimum that you should consider when you prepare a budget. First of all, look at the type of income structure. What we mean by that is your income fixed? For example, you earn rental, or does your income depend on the widgets that you produce? Or maybe both. Maybe you have an element of fixed income and an element of variable income. So you need to first look at your income structure and budget the income based on every potential revenue line and how that is going to be earned. Then also remember to take into account the fixed commitments. You start off with that. Things that you can't get out of, whether you produce or not, you can't get out of it. So for example, rates and taxes, you have to pay it. Phones, stationery, rent, things that are fixed. Maybe some salaries are fixed. You have to budget that. Think about the availability and cost of stock. When will you be able to get stock? And in order to get it ready to produce, then when do you need to start ordering? Look at the stock levels and look at what you need to order. Then track your budget, of course, at the end of every month, period, week, whatever works for the company. You need to track and compare the budget to what the actuals were. And you might need to, in fact, adjust your budget if you feel that maybe some assumptions have changed, or maybe some goals were achieved earlier or not achieved at all. Then you might need to adjust your budget. Keeping into account the long-term considerations. What are we planning to happen in this market? For example, inflation, interest rates, changes in tax rates. Remember that you might still be committed to pay debt, to repay assets that you have purchased, that you have financed. And then also we talked about adjusting the budget, for example, for seasonality or economic factors. We're now in the middle of the COVID-19 pandemic as we are recording this, and obviously all budgets need to be revised.